Hello, this is Mike Swanson. You're listening to the Wall Street Window podcast. In a few moments, I'm going to be speaking with a very special guest. I'm going to be talking with David Skarica, who runs the website addictedtoprofits.net. Dave and I had a very great discussion about the financial markets, got his opinion on what he thinks is going to happen next with them, what's going to happen next with gold. Actually, Newmont Mining made a new high for the past 52 weeks on an intraday basis today. It's a very interesting development, whereas most stocks are way off their recent highs. But is that meaningful? We'll find out with Dave. But before I talk with him, I want to tell you that the odds of you actually dying from the coronavirus have drastically shrank in the past 24 hours. That's according to the World Health Organization. Now, the AP Newswire put out a story today with this headline: virus death rate still uncertain as mild cases are missed. If you want to read the story for yourself, type that in to Google and you'll be able to find it. But I just want to read you two paragraphs that have to do with the risks that you now face. By the time people elsewhere in China were getting sick, authorities were better able to test for the virus and uncover people with mild cases. Consequently, the death rate in the rest of the country was strikingly lower, 0.7%. When it took a close look at what's happening in China, the World Health Organization concluded 2 to 4% of the patients in the city of Wuhan, the outbreak's epicenter, where a flood of early cases overwhelmed health centers, had died. So 2 to 4% of the initial cases, the severe cases, the first ones discovered in the city of Wuhan, were fatalities. That's tough. Now, here's what I want to quote from the rest, though. By the time people elsewhere in China were getting sick, authorities were better able to test for the virus and uncover people with mild cases. Consequently, the death rate in the rest of the country was strikingly lower, 0.7%. So when we see these statistics, we know we're not dealing with the influenza pandemic or something like it that happened between 1918 and 1919. You know, the odds of you dying from the coronavirus are low. The odds of catching it are low, much less dying from it. And I just wanted to share that bit of statistical information with you. So all that said, one quick break, and then we'll be speaking with David Skarica of addictedtoprofits.net.
Carmine Savastano, Human Time Bomb, The Violence Within Our Nature, poses significant questions and considers the evidence that violence shapes the past and present. Author and Professor David T. Beato calls it an impressive tour de force. Savastano shows a mastery of relevant work in biology, anthropology, and intelligence. Each chapter will challenge readers to rethink old assumptions. Doctor of Psychology R. Blackstock notes, "It is a long, hard look into the potency of our collective shadow that is extremely relevant in today's socio-political climate." Historian and author Larry Hancock declares, "This work is a slap on the back of the head, a wake-up call, and a serious reality check as to the true human condition." Order your digital and print copies now on Amazon.com. For more information, visit tpaak.com.
Hey, good. How you doing, Mike?
Great. Yeah, thanks for joining me. It's been a wild couple weeks since we last spoke. Last week, the stock market had a meltdown. The Dow and S&P fell roughly 15%. But today, as we're speaking on the 4th of March, everyone seems to be very excited because the S&P had a smashing rally, and the NASDAQ is up 334 points. The Dow is up over 1,000 points. People on MSNBC are celebrating what they think is the defeat of Bernie Sanders, while if you flip to CNBC, they are today celebrating Federal Reserve action, whereas yesterday they seemed to be in dismay that they weren't doing enough. But now that the market is up, everyone is excited. is this now the time to buy stocks?
Well, I do think we could get a short-term rally and continuation of this rally, and I'll tell you there's a number of reasons. Number one is just the fear threshold that we hit last week. Like, the one thing you can't ignore is when the VIX goes over 40 and especially to 50. That happens on very rare occasions. If you go look at, like, let's say since the financial crisis, that happened in 2010, in 2011, in 2015, 2018, and now. So when you've had these big spikes, even if the market ultimately heads lower, like in 2018, it did swoon in the fourth quarter. Usually that kind of spike in the VIX and fear tends to be a good bottom, at least an intermediate term bottom. I would say for a 3 to 6 month period. Even in bear markets, if you go look at 2001, for example, I remember there was a big bottom. I think it was about February, March of 2001, and the VIX spiked to almost 40, and then the market rallied for a number of months before rolling over, and then 9/11 happened, and there was a big sell-off. So what I think is that's what I think is occurring, is that we can get, even if it's a bear market, we're going to get a pretty good sized bottom here in the market. And it kind of, if you're someone who's really worried about the coronavirus, it kind of actually lines up, because we've been talking about this off air, and I've studied a lot of these things, and certain ones like SARS and bird flu, Ebola, they all kind of just went away after a few months. But even if this is something larger, if you look at the biggest pandemic we've had in the last few hundred years, which was in 1918, 1919, the first wave was kind of like this wave in the corona. And then when we hit the flu season, when things got cold and people get sick in October of 1918, that was, okay, now I'm not predicting something like this, because that was brutal. I think 5 to 10% of the world's population died. What I'm saying is the second wave, the strain was stronger, and again, it occurred during kind of like when the weather got colder and flu season started again. So what I would think is that this will probably go by the wayside as the weather gets warmer, and then could come back if it hasn't been properly dealt with. Because here's where is one similarity, which is a bad thing, is that in 1918 we were still in World War I, and no one wanted to talk about what was really going on with the pandemic, because they figured, there was restrictions on press because of the war, and then also they didn't want to give the other side an advantage. So if Germany came out and said, "Oh, we have a bunch of sick soldiers here," then France or England could see that as a weakness and attack them, or vice versa. So that was one problem that it didn't tell. And right now, I don't think people are really telling how many people are really sick. They might not even know they have the coronavirus, or whatever, the COVID-19 or whatever they want to call it now. And the reason being is, it seems to be not that much worse than the flu right now. So if you get something, you might just think you're sick, right? It's not like, you have malaria or something extreme with it. So that's the first part, is that I think that we hit this extreme, and then it kind of, and let's face it, a lot of the selling was over the fears over that. And because we hit that extreme amount of selling and fear, we're probably due for a rally. And then kind of, like I said, the makeup of where we are in the calendar makes that. And then finally, the second thing is that Fed rate cut. We were talking off air a number of times the last few weeks, and I kept telling you that I could see the Fed cutting between meetings, because when you get something bad, economically happening, 1998 with the Russian crisis, 2001 after 9/11, 2007 to 2008 financial crisis, they did it. Essentially, when you get these bad things happening, the Fed will, and it looks like it's going to have serious economic effect, not just to sell off in the market. The Fed will step in between meetings to kind of have that quote unquote surprise effect, right? To have that effect where they're going to think it's going to catch maybe short sellers off guard, market participants off guard, and maybe have a bigger bang for their buck by doing it. And if you look at the first one they did in 2007, for example, that was in August of 2007. that essentially occurred after a similar sell-off, like we just saw, a 10 to 15% sell-off. And that led to a rally that lasted a couple months. And then the market peaked in October 2007. A lot of people are pointing to the other ones, like, for example, in 2008 after Martin Luther King Day, and, actually in 2008, say in September or something, where the market kept kind of moving lower. But I think this is more similar because this is the first one to that, that August 2007. And like I said, then the market actually did rally for a number of months before topping out. And we'll just have to see what happened. In the last thing in case of 2007 was that actually it was a double top. If you go look at the S&P went back to its July 2007 highs in October and then peaked out. So we're going to have to see if that occurs again here. I don't know. This was a lot of technical damage has been done. We have a Dow theory sell signal that transports never got up to the 2018 highs during the blow off in the S&P and the Dow. So I don't know if we're going to be able to go back up to highs. And even if we did, again, I do believe longer term something like the Dow theory, there's no way those transports are going to go to new highs if the industrials or S&P were able to.
Yeah, I mean, just looking at the stock market averages, I'm looking at a chart of the S&P 500. You would think after the big drop of last week and this strong rebound that the market would go sideways for several weeks or maybe even months before it has a real meaningful move. That's essentially what it did in 2018. The Dow fell about 10% in just a few days, then went sideways for 3 or 4 months. But there's a lot of anger or stress, I think, out there among traders and even in people on the
media.
I mean, it's taken all of us by surprise. It took me by surprise, I will say. And then when the Federal Reserve did lower rates on Tuesday, the market had already gone up on Monday. And initially, I turned on CNBC to get the reaction. And this Josh Brown was on there. Some people call him Downtown Josh Brown.
His nickname.
And he was very angry, and he was making the argument that the Federal Reserve should not have lowered rates because the market went up on Monday, and that there was therefore no reason for them to do it, and they shouldn't have done it. I mean, he was about to turn red, and then after he said these things, the market went red itself. So what do you think of argument that the Fed shouldn't be lowering rates because the market isn't that bad, and maybe the coronavirus isn't that bad either?
Well, of course, first of all, to criticize the Fed, I'm more critical of what they've done more than what they just did. And I'll tell you why. We all know they've created this bubble, right? They dropped rates to zero after the financial crisis. And then in 2013, 2014, you could have argued, the economy was half decent there. Then the Dow was getting back to its all-time highs, that they actually should have started raising rates then to start to normalize much earlier. But instead, in 2012, 2013, they did QE, and that pumped the market. I think that's what led to this market becoming just from a bull market into a bubble because of all that liquidity. So that's where you can criticize the Fed. But in terms of now, I say, what are you supposed to do? People are saying on the Twitter sphere where there's a lot of kind of perma bears and stuff, they're like, oh yeah, blasting the Fed. Oh, all it took was a 10% drop in the market for them to panic. But I also say, well, what are they going to do? Hold rates at 3%? The 10-year bond is 1%. Even before this, the bond was about Fed funds. If you take the 1.5 to 1.7, in the middle of that, or 1.75, is about 1.63, right? Well, you had 1.63 on the Fed funds, and the 10-year bond is 1%, right? So, and the 10-year bond is 1%. Well, that's a huge inversion. Just if you just think if you times the numbers by 10, and we go back to 1980 when you had double-digit interest rates. If the Fed funds was 16% and 10-year bond was 10%, you would say the Fed really needs to cut because they're behind the curve. So they, to me. where the 10-year bond is, it's actually fine by me, them cutting it, because the 10-year bond is probably telling you there are problems in the economy. It is slowing down. You might even get a global recession in the first quarter because of the corona fears. So I have really no problem with what they did. If anything, I think the Fed should be more reacting to that 10-year bond. If you go look at what they used to do in the 80s and 90s, and I did a podcast about this months and months ago, I noted that they weren't just always in one direction. If you go back to 2000, all they've done since 2000 is either they've been in a cut mode, like they were from 2000 to 2002, in a raising mode, like they were from 04 to 06, then another cut mode, like in 07, 08, and then another raising mode, and now they're in a cut mode. The Fed used to, when they were in cycles of cutting or cycles of raising, they would maybe take one back. So they would do like, say, three raises, of a half point each, and then they might cut a quarter and then raise again. So I would think that the problem is now is all they're doing is just being in one mode and then really behind the curve because of that. Like really when the 10-year, remember when the 10-year bond went way over 3%? I think they should have been raising more in reaction to that. And, they could have had this rate up to 3% and had more room to cut when this, like a problem like this occurred. So my issue is not really them reacting and cutting now. My issue is more that I just think they're too set into one way or the other. And maybe it's because the market is so fragile now. Maybe because the market is so overvalued. It's such a bubble that they're scared of, okay, like, even, now that we're cutting, now rates are what, 1%? Well, let's just say for argument's sake, this was just a V bottom. This corona thing goes away like SARS and other smaller illness breakouts, and the market goes straight back up. Well, wouldn't it be prudent for the Fed just to raise rates back to 2%? The bond sells off and everything's back to normal. But they're not going to do that. They're going to sit here at where rates are now for probably a year or two. So my opinion, my biggest criticism is that they created this bubble and they're not flexible enough, of adjusting rates here and there. And they should be watching the 10-year bond more because, we've known since last year, you can say, oh, the Fed is too loose, but the 10-year bond has been telling you for a year that things have been weakening. It's under 1% now. We're getting into the Germany and Japan range.
Yeah, that's true. I mean, it was last August that the yield curve inverted on the 2-year and the 10-year bond, and that is the most accurate forecasting indicator of a coming recession within 6 to 12 months later. And here we are. It seems as if most likely that indicator is accurate, or else whether it's just coincidence or not, it turned out to be accurate.
Well, I think that's the thing is that, like I talked about the Dow theory, and that's something that people say, oh, that's an old theory, doesn't matter. But the Dow theory and the inverted yield curve both told you there were problems. Like, the Dow theory, the whole point of it is transports tell you goods and services and people moving, right? People traveling, spending, or, just railroads, ships, parcels by FedEx, etc. That's telling you that goods and services were not moving as well as, say, these bubble stocks going up. And that happened in 99, 2000. That was the warning that tech bubble was blowing off and ending. And yeah, the Dow theory was right. And like you said, that inverted yield curve where people were just poo-pooing, saying, oh, rates are too low, you can't really judge anything by it. Well, guess what? Yeah, it looks like it was calling for a serious weakening in the economy or a recession. And by the way, so what this all means for me personally is I really think this is good for gold, because now you're going to have, rates going to zero, and then the next move is going to be more QE, right? So this is when people will get into precious metal assets. And I just think what's happened now is what's going to happen in the next recession. The debts around the world are just too big, right? And they're just too big, and there's too much debt, and that's going to lead to gold going higher.
Well, I mean, the interesting thing about gold is I own gold in my portfolios, and gold did drop last week a little bit, but not as much as the stock market did. And there's less volatility in owning gold, and gold bounced right back up. It's around right under 1650, But Newmont Mining just made or touched a new 52-week high today. Actually, it is a closing high for Newmont Mining. So there's not many other stocks in the entire stock market, much less sectors, that can say they made a new 52-week high today. But one thing about the mining complex is that a lot of the junior miners did get hit in this market volatility, but they have not yet bounced back up as much as Newmont Mining has. Do you think there could be an opportunity there to get something that may have gotten oversold?
I think too, what you're talking about with Newmont and the like is what's interesting about it is, that's leading the way. So usually in a mining bull market, you go from the big seniors like Newmont to the mid tiers to the juniors. So where I'm positioned right now, I own a couple of the producers, like Eldorado is one of my favorite companies. But what I'm literally looking at is, me and you've talked about a while, is either the juniors or the near production plays, or the juniors that are going to go into production. And what by doing that, because I can't time exactly when those companies are going to start to outperform, I may be giving up some short-term performance. I may be missing out on Newmont going up 5 or 10 or 20%. But these kind of companies I'm looking at, and by the way, I'm going to compile a report, listing about 10 of them or so, right? I'm looking at are if gold goes to 1900 and higher, and these companies go into production, you get the combination of higher gold prices and their production coming online at the perfect time, right? So, like one company we've talked about in the past is Galani, which I own in a family's account, a family member's account, and they produced 33,000 ounces of gold last year, and they're going to produce like 50,000 this year, and it's a 10-cent stock. It only has a $20 million market cap, and that's the kind of stock, that if they're producing 50,000 and they can make keep their costs down, that's the kind of stock that could be worth 200 million, in a good gold market. So, and of course you do the math, that's 10 times. So that's the kind of thing I'm looking for right now. So I've been through a number of these cycles, and those companies either building up ounces in the ground or going into production while gold is going up, you're going to get 5, 10, 15x and them, where you're only going to get, whatever, a double or a triple. Now, those are really speculative companies too. So they're not for your whole gold portfolio. They're just for a fraction of it. But I do believe the risk reward is better in them than something like Newmont. But also, like you just said, it's not just Newmont. If you go look at the GDX, and because of the strong bounce it's had the last few days, it's not that far away from the high it made last week. So that's another thing too. The gold stocks are performing much better than the market as a whole, and I think we're going to see a continuation of that. And then, by the way, one reason I really like the gold stocks this time is I do think that whenever we get some kind of market bust, the market falling 30 to 40%, maybe 50%, like 2008, 2009, from its highs, the bear market. I think this time around, again, because of the debt problems, we're going to see much more serious inflation following some kind of bust, which may be short-term deflationary, and because of that, I'm more inclined to be in gold miners. I want some shorts and hedges, but I think that's the better play than just shorting, because I think they're going to really, really reinflate even more this time around.
Oh, that's what's coming. When the last interest rate comes, what follows is going to be massive QE operations. Well, thanks for taking the time to talk to me and everyone else. We'll have to do a follow-up interview soon, because these are wild and woolly times, and everyone listening should go to your website, addictedtoprofits.net.
Okay, thanks, Mike.